Hello everyone, my name is John Cunnison. I'm the Chief Investment Officer at Baker Boyer Bank, and I want to welcome you all to the monthly market update. So today we're going to talk a little bit about the economy, which includes, of course, the government shutdown that recently happened to the federal government. We'll talk about markets, both U.S. and international, and the really extraordinary returns that we've seen there. We'll talk about how resilient we expect those returns to be. In effect, can this continue? We'll talk a little bit about the tried and true principles of developing a diversified portfolio that's resilient through any market environment. So let's begin with the economy. The government shutdown. As many of you know, non-essential functions, right, are currently not operational in the federal government today. And this is the 21st time we've seen a government shutdown since 1975. Right? So the U.S. economy is not new to government shutdowns. In fact, back in the 1970s, there were years where we saw 2 or 3 government shutdowns in a given year. So this is not new. Now, about 750,000 of the 2.9 million, approximately, federal workers are currently being furloughed. Now, what does that mean for the economy? Well, we have these 21 instances since 1975 to draw on to ask the question, what does it mean for the economy? And when we look at data historically on economic growth during a government shutdown and after, what we see is the effect typically is negligible. There's really no lasting effect. What does it mean for markets? Well, when we look at stock and bond markets over those same periods, we look at the 10-year bond treasury return, when we look at the S&P 500 return, again, we really don't see any lasting effect. What we see with the markets is that whatever trends were in place in stock and bond markets prior to a government shutdown tend to persist through and after the government shutdown. So I don't think we should be too concerned about the effect of the government shutdowns. Where there may be some potential for concern is with the potential for mass layoffs. That's something we haven't seen historically, and that may be something new here and may have more lasting effect on government or on economic growth. And the other is the lack of available data for the Federal Reserve to make monetary policy decisions. So a lot of the data that goes into monetary policy decisions by the Federal Reserve, a lot of that comes from the federal government, especially as it relates to the labor market and inflation. And if we look at the labor market right now, prior to the government shutdown, we saw at the margins signs of weakening in the labor market, meaning fewer job openings at the margins. We're beginning to see the unemployment rate slowly creep up. But I think against a lot of economists' expectations, we've seen inflation numbers that have been fairly tame. Right? So in the absence of government data to guide the Federal Reserve, they're likely to assume that the existing trends will stay in place, right? Meaning a softening labor market and stable inflation. If that's the case, then we're more likely to see the Federal Reserve bias toward cutting interest rates at the end of the year. So we're very likely to see 1 or 2 cuts if this stays in place. Now, what do rate cuts mean? Well, with that, let's turn to markets and talk a little bit about stock and bond markets. So stock markets love rate cuts. Why do they love rate cuts? Because that means that borrowing is less expensive, both for individuals and for businesses, right? And that tends to be stimulative for the economy. So we have seen really strong returns this year, so year to date, and as we look back in history. And I think if we just take a quick look at this chart, I think it'll give us some sense for the kinds of returns we've been seeing, right? If we look at 1 year for the top row, then 5 years, 10 years, 15, and 20, we see just a sea of green arrows, a couple of red arrows, but by and large, green arrows, right? That is just an indicator of the relatively strong returns we've seen over time. Now I'll draw your attention to the 1 year row of numbers, that first row, and the fourth row, which is the 15-year row of numbers. I just want you to look at the very first number in that 1 year row, right? 17.41%. That's the return to the US stock market for the prior 12-month period, ending with the third quarter. 17.4% is really strong. And then look at international developed, right, which is right next to that in the 1-year column or row of numbers, and the emerging market numbers, 17.32%. So the 12-month period has been incredibly strong. Now, I want you to jump down to that 15-year row, right? Well, here we see something slightly different. We continue to see incredible strength in the US stock market. That's that first column, 14.23%. That's an average annual return. Well, the long-term average annual return to the US stock market, going back to 100 years, is around 10%. So for this last 15-year period has been incredibly strong for the US stock market. When we look at the international developed emerging markets, right next to that number in the 15-year, we see something that's less than half the US return, right? So I think our clients will be forgiven for not being really enthusiastic about international stocks. Today, however, I think we should begin to shift our mindset around international stocks. There's a lot of reasons to like what we see there. Now, this brings us to the question of, with these strong returns that we've seen in markets, can we expect those returns to continue? Now, as we look at the US stock market, right, a lot of what has driven the exuberance over US stocks has been investment in AI and investment by AI companies in, of course, large language models, collecting data for AI. Now, here I would just use an analogy, right? If you think about investing in companies that are trying to capture, returns to this revolutionary new technology, which is AI, think about the first owner of a golf course, right? This is a company or a person that may come in, buy a golf course, but that means they have to put in all the landscaping and the irrigation and build the clubhouse. There's a lot of expense that goes in, which means that they're going to have to drive a really strong business at that golf course if they're going to generate a return. Sometimes it's better to be the second owner of the golf course or the third, right, where you're buying that at a much lower price. The other way to invest in that, using the same analogy, is I want to be the irrigation contractor who goes in and does the irrigation and receives a lot of that investment. I don't necessarily want to own the golf course, right? Not be the first owner. Same thing with AI investment, right? A lot of this investment that's being made is extraordinarily high. Enormous amounts of investment going in by a lot of companies who are competing for a return on that investment. Right? That tends to be a recipe for lower future returns. That doesn't mean it's not exciting. It's incredibly exciting. And where the benefits to all this investment are likely to accrue are to you and me, to consumers who get to enjoy this incredible technology. It'll be to other businesses who get to use it to enhance their business. But from an investment perspective, I think we need to be somewhat cautious. Now, we're going to talk in much more detail about these concepts at our upcoming economic update, which is a presentation we do for our clients in person, all three markets, Walla Walla, Tri-Cities, and Yakima. If you're interested, if you haven't gotten an invitation and you're interested in attending, please send me an email. It's at cunnisonj@bakerboyer.com, and we can talk about getting you an invitation. We'd love to have you join us. Now, that's looking at US markets and expectations for future returns there. What about international markets? Well, we've seen, year to date, real signs of strength in international markets. This is something that Baker Boyer has been expecting for some time for three reasons. One, prices for international stocks are simply lower than they are for US stocks. So when you buy a stock, you buy a share of the future earnings. Right now, buying those future earnings with international stocks tends to be less expensive. Yields, dividends that you get from international stocks tend to be higher. And the final thing is just currency, right? So when you buy an international stock, you also buy the currency that that stock is issued in. So if I buy, for example, Unilever, right, which is like the Procter & Gamble of Europe, I buy it in euros. Well, if while I hold Unilever, right? The dollar weakens against the euro. When I bring my returns from euros back into dollars, they buy more dollars, right? So that enhances my return. And what we've been seeing recently is just some concern around US assets. A lot of it has to do with tariff policy. There's some other reasons for that. But we've seen the dollar weaken quite a bit year to date. And there's a lot of economists that expect that that trend can continue. That's a tailwind to international stocks. So a lot of reasons to like international stocks. We don't need to overdo it, but having a meaningful allocation is important. So when we look at just comparing US and international stocks and the returns that we've seen, these strong returns, can they continue? We would argue that those trends are more likely to continue for international stocks than they are for the US. Now let's just back up and look at portfolio construction. How should you be thinking about your portfolio in this environment? Lots of uncertainty in the economy and in markets, interesting trends around technology. How should you be allocating? Well, I think it's important, more important perhaps than ever, to think about diversification. And let's think about 4 things. One is, when you're thinking about your your US stocks, I think it's really important to think about perhaps leaning out of some of the largest US companies. These are the ones that, primarily the Mag 7. Wonderful companies, interesting technologies, but this level of investment that we're seeing in AI could be somewhat destabilizing. So we're just gently leaning out of those companies into less expensive areas of the market. When we think about international stocks, we want to hold a meaningful allocation, right? Diversifying perhaps at the margins away from US stocks into international stocks. Bonds. Bonds are going to play a really important role in everyone's portfolio. Yields today are attractive. They're above inflation, which means you get a real return. And in any time where there's stock market volatility, we're likely to see bonds play an important role. Finally, real assets. And the role that real assets play is if we see any kind of surprise inflation in markets, whether that's stagflationary or inflation with a growing economy, real assets can play a very important role in diversifying stock and bond markets. So it's important to diversify in your portfolio as always. I'm going to stop there. If any of you have any questions about anything I've said here or anything else, please reach out to a member of your Baker Boyer team or reach out to me directly and we'd be happy to help.